In December 2025, Tesla hit an all-time high of $489 per share. Today it trades around $340, a drop of roughly 30% from its peak, and down more than 20% since the start of 2026. And yet, in the same period, Tesla launched commercial robo-taxi services in 3 U.S. cities, posted 16% revenue growth, and began production of what Elon Musk calls the most important product in human history. Tesla is the same company it has always been, impossible to ignore, impossible to agree on. Today we lay out exactly what happened, what the business looks like, and both sides of the story. The drop from the all-time high was not caused by one thing. It was a collision of 5 separate headwinds. First, the delivery miss. This was the single biggest catalyst. In Q1 2026, Tesla delivered 358,023 vehicles, missing Wall Street's consensus estimate of roughly 365,000 to 370,000 units. More concerning than the miss itself was what came with it. Tesla produced 408,000 vehicles, but only delivered 358,000, leaving over 50,000 cars sitting in inventory. In the car business, growing inventory is a red flag for demand weakness. The stock fell sharply the day those numbers were released, and 3 major Wall Street banks cut their price targets in the same week. Second, the Elon Musk brand problem. This is the factor that is hardest to quantify but impossible to ignore. Musk's involvement with DOGE, the Department of Government Efficiency under the Trump administration, triggered a measurable consumer backlash. European sales fell nearly 39% year over year during the controversy period. California sales, Tesla's largest U.S. market, hit a 4-year low. Tesla's California sales are being directly attributed by researchers to the impact of Musk's political actions. This is not a valuation model issue. It is a real-world sales problem. Third, the CapEx shock. When Tesla reported Q1 2026 earnings in April, revenue and earnings per share were actually good. Non-GAAP EPS of 41 cents beat estimates of 30 cents. But buried in the report was a guidance update that rattled investors. Tesla raised its 2026 capital expenditure plan to over $25 billion, roughly $5 billion above the prior plan, and 3 times what it spent in all of 2025. Goldman Sachs projected negative free cash flow for the year. The message was clear: Tesla is spending at a rate that will consume most of its current profits for years before the new businesses pay off. Fourth, competition accelerating globally. BYD, the Chinese electric vehicle giant, is now selling more electric vehicles globally than Tesla in several months. In Europe, local brands and Chinese imports have taken significant market share. And in the humanoid robotics space, a key part of Tesla's future story, NVIDIA just announced a partnership with Chinese robotics firm Unitree, adding fresh competitive pressure in the week the stock fell 5% on a single Monday. And fifth, the valuation math. Tesla trades at a trailing price-to-earnings ratio of over 400 times. JP Morgan has a price target of $145, implying 60% downside, arguing that it is mathematically impossible for Tesla to grow its current modest profits fast enough to justify a market cap above $1 trillion based on its car business alone. The entire premium is a bet on Musk's unproven future products. Now let's look at what the company actually reported, because the income statement tells a more complicated story than the headlines suggest. Q1 2026 revenue came in at $22.39 billion, up 16% year over year. Operating income grew 136% to $900 million. Non-GAAP net income increased 56% to $1.5 billion. Free cash flow reached $1.4 billion, up 117% year over year. And the company ended the quarter with $44.7 billion in cash. The automotive gross margin improved to 21%. Services revenue, software, FSD subscriptions, charging, grew 42% to $3.75 billion. FSD active subscriptions hit 1.28 million, up 51% year over year. These are not the numbers of a company in crisis. They are the numbers of a company generating solid cash flow from its car business while investing that cash, and much more, into an entirely different set of products that do not yet appear on the income statement. That tension between a solid present and an uncertain future that is priced in at enormous multiples is the essential Tesla question. The bull case for Tesla in 2026 is built on three pillars that have nothing to do with selling cars. First, the robo-taxi business is real and expanding. Tesla launched unsupervised robo-taxi rides commercially in Austin, Dallas, and Houston in Q1 2026. Paid robo-taxi miles nearly doubled sequentially. Expansion plans are underway for Phoenix, Miami, and Las Vegas. The Cybercab, Tesla's purpose-built autonomous vehicle, has begun pilot production in Texas. When Musk says Tesla is transitioning from a car company into an AI and robotics platform, the robo-taxi launch is the first tangible proof that the transition is actually happening. Second, Optimus. Tesla's humanoid robot is slated to enter mass production in 2026. Construction of a 1 million-unit factory is about to begin. Musk has repeatedly called Optimus potentially the biggest product of all time, far exceeding the value of the entire vehicle business. ARK Invest's bull case assigns Optimus alone a value of over $7 trillion by 2029. That may sound extreme, but even a fraction of that vision, a robot priced at $20,000 to $30,000 that handles household tasks, would represent a market that dwarfs the global car industry. Third, the energy business. Energy generation and storage revenue was $2.4 billion in Q1 2026 alone. Megapack, Tesla's utility-scale battery product, is one of the fastest-growing businesses in the energy sector. As the world builds out grid infrastructure for AI data centers and renewable energy, Tesla's energy business is quietly becoming a major revenue stream that most investors do not factor into their models. The bull case price target from Wedbush, Baird, and Bank of America averages $433, implying 28% upside from today's levels. The most aggressive bulls project over $1,200 per share by the end of the decade if Robotaxi and Optimus deliver. The bear case is equally clear, and it starts with the gap between promises and profits. The core car business is under genuine pressure. Deliveries have declined year over year. Inventory is building. Price cuts have compressed margins. The Model S and Model X have been discontinued. The Model 3 and Model Y now represent 97% of all deliveries, meaning Tesla's product line is effectively a two-car company betting everything on future products that do not yet generate meaningful revenue. The robotaxi launch, while real, is coming with problems. Reports of operational glitches, long wait times, cancellations, rides not completing, have emerged from Dallas and Houston. Panasonic battery production delays are threatening volume ramps for Cybercab, Tesla Semi, and Megapack 3 simultaneously, and older Tesla vehicles with Hardware 3 chips cannot be added to the robotaxi fleet without costly retrofits, creating a customer service problem for owners who paid for full self-driving and are now finding out their cars cannot run the unsupervised version. The China problem is unresolved. FSD approval in China, which would unlock Tesla's largest potential robo-taxi market, remains pending, with significant regulatory uncertainty. And in the meantime, BYD is selling cars at a pace that Tesla cannot currently match. JP Morgan's target of $145 represents the most bearish major analyst view, and the argument is simple. At 400 times trailing earnings, Tesla has almost zero margin for any execution miss. One disappointing product launch, one delay in Cybercab production, one setback in FSD regulatory approval, any of those could trigger a correction that the valuation has no buffer to absorb. Tesla is not a car company anymore, or at least it is desperately trying not to be. The car business is real, profitable, and generating cash. But the $1.1 trillion market cap is built almost entirely on the promise of autonomous driving, humanoid robots, and AI infrastructure that is still in its early stages. The stock has fallen 30% from its all-time high, not because the business collapsed, it didn't, but because the market is asking a harder version of the same question it has always asked about Tesla. Is the vision real? Is the timeline credible? And is the price you are paying today justified by what actually exists today? The bull says, of course, you are buying the future at a discount. The bear says, you are paying for a future that may never arrive on the schedule promised. Both arguments are serious. Both have been right at different moments in Tesla's history. And both will continue to be debated as long as Elon Musk is building things that have never been built before. Hit like if this gave you a clearer picture and subscribe for more deep dives like this one.